Good evening, everyone, and a very warm welcome to all of you joining us today as we are introducing our latest equity fund, which is the Senfin Select Factor Fund. So in today's webinar, we are looking forward to give you insights into our fund strategy and selection process. So we also have with us our Director and Chief Executive Officer of Senfin Asset Management, Mr. 𝐿𝐺𝐻 Sukumaran. So Mr. 𝐺𝐻, would you like to give us a quick introduction about the company and then take through what the fund is about and why anyone would invest in it?
Yeah, hi Bimash. I hope I'm audible. Am I audible, Bimash?
Yes, you are.
Right. Okay, great. We'll very quickly, I don't want to take too much time in terms of the company, but very quickly, if we could move the slides forward, we could just very quickly just do a very quick summary, because I think most of the people would be here today really to talk about the fund itself. But just to give a very quick summary of our company to those who don't know too much about us. So we are an SEC licensed unit trust company. We are a subsidiary of 𝐸𝐶𝐻 Finance. We've been in the business now for almost 15 years. The company used to be known as 𝐶𝐻 Asset Management, but in 2022, it was acquired by 𝐸𝐶𝐻 Finance, and we've been with the company since, and we've been seeing strong growth. The company is one of the only Fitch rated asset management companies in the country, and asset management, our money market fund is a AA rated by Fitch as well. We won quite a few awards, the CFA awards for best unit trust as well. I think three in a row that we've had so far. We're really focused on in terms of the mutual fund side. We've currently got 9 funds. This would be the 10th one. The Select Factor Fund would be the 10th fund that we've launched. Majority is in equity base. So we've got 7 with the Select Factor Fund. We'll actually have 7 equity funds. This will be the 7th equity based fund that we've launched. So if you could go to the next slide, there'll just be a very quick breakdown of all the funds that we have. So I mean, all of this is available. So if anyone is really interested, you're more than welcome to check on our website or get in touch with any of us. I believe at the end of this presentation, my email address will also be there as well. So you're more than welcome to drop me an email as well if you'd like. Bimasha, let's keep going forward in the interest of time. So we'll focus on the fund. We can skip this slide, Bimasha. So basically, just before I get into the fund itself, we have to talk about the underlying assets. So why we're actually going with equity. So as many of the people here would know, the country, as after we came out of the crisis in 2022 and the ending of the crisis in 2023, we saw fixed income rates from their peaks, almost up to 30% coming off significantly in the last 2 years. So you can see treasury bills have all dropped below 10%. I mean, everyone would be able to tell based on the change in interest rates that they're getting on their savings deposits, on their fixed deposits, and even from money market funds such as ours. So this is part of the push for development and for expansion in the country, as well as, it's to control a lot of factors, which I won't go into much detail. So basically, given that we've seen a lot of fixed income drop, we've seen a lot of funds in the market, in capital markets, and people have been looking at alternative sources. And obviously, equity is generally one of the main sources. I mean, we really saw the first massive upgrade, as you know, just after the elections, just in the run up to the presidential election. So the first part of September, we saw the way the markets skyrocketed upward. And then after that, they broadly stayed upward. I think the market peaked originally in February this year, where we set the first all-time high that we saw this year. I mean, I know we set an all-time high a few days ago as well, and today as well, most probably. But what I mean is that was more or less growing from the uptick on a lot of things, general sentiment in terms of strengthening earnings of companies, a positive outlook on the economy, interest rates obviously coming down, the DDR to some degree being sorted, the country being declared no longer bankrupt. All of those things factored together, which is why we saw a massive jump in the month of December, which was, I think, one of the largest in recent times in terms of within 1 month. And then that continued in January and peaked off in February because before we saw it easing downward. Then obviously in April, we saw a massive drop following the Trump tariffs, but that was a very, very short term. It was more panic driven move as opposed to anything based on long term. And now again, we've seen the market slowly move up quite well in the last couple of months. And it's been continuously up, I think, in June and towards the latter part of May as well. So I think we went well past 17,600 points. A lot of brokers, a lot of people in the markets are talking about 22,000, which is on the high side. But it's starting to look like, 18, 19, 20 is a very real possibility. So the reason for that is, again, continued strong earnings are expected. So we're looking at a lot of companies now getting their act together, so to speak. Getting their act together, meaning not that these companies, they didn't have their acts together in the past, but rather it's more along the lines of these companies. Okay, a lot of the uncertainty, a lot of other issues are out of the play, to some degree out of the way. So companies have really started focused on where they're going to go in terms of operations and all of that, as well as improving economic conditions. So obviously that has led to significant investor confidence, and that is what is looking at growing markets. The other side, obviously, is the taxation. So as you all know, taxation policies, whilst tax was reduced to some degree, income tax from 1st of April, there still is a fair amount of taxation that people have to face with, and further the increase in WHT. So what we're really looking at now is more or less something where tax to some degree is not apparent. So equity currently is still not taxed. Even capital gains is not taxed. Your income is not taxed. You'll only pay on dividends if at all. So that is a source of or a place where investors can avoid, or not avoid, that's the wrong word, but where investors will not be faced with significant tax. So strategic investments in equity, timed investments in equity, obviously is one of the main sources that people are looking at. So that, combined with the facts that I mentioned before in terms of the positive, the fundamentally positive things, all of these together are what we're really seeing a push, this equity push that is happening. So that's where we really stand right now in terms of equity. So if I were to connect that to why we're launching this fund, so Bimasha, if you could go to the next slide, I can then connect the two. So before we go into detail about this fund is very simple. It's your standard equity fund. However, it's the selection methodology that is a little innovative, so to speak. It's nothing amazing, it's nothing fantastic, but basically what we're really looking at is, we feel like that the markets now have come to a point where, excluding any unexpected black swan events, and yes, while I know those things can always happen, what we feel is the markets have come to a point where this is where the market would have notionally been had the events of 2019 to 2022 not happen. So when I say 2019 to 2022, I'm talking about first the Easter attacks in terms of the country. Then I'm talking about the 2 years of COVID. And then I'm talking about the currency crisis. So we got 2 years of global events, and then 2 years of very Sri Lanka specific events. So in that period, had those events not happened, hypothetically, and the country had been on a general path, this is where the market to some degree would have been come to if we looked at a normal linear movement. So that is one positive variable as to why markets have now stabilized, or what we expect is the massive dips have stabilized. Again, like I said, excluding any major black swan events. The other thing is what I mentioned when we were discussing the previous slide, is that we've seen, there's investor confidence, there's a general positivity in terms of macro markets, all of that. So when you've looked at all of those things together, what our view is that, okay, we've come to a point where the market is now, to some degree, going to move on fundamentals, on technicals, on strong underlying factors and variables, as opposed to sentiment. Don't get me wrong, Sri Lanka is a market that in my entire career so far has run on fundamentals. And I think up until the day I retire, this country will continue, or rather, our capital markets will continue on sentiment. But at the same time, we feel like now that we've reached a certain point, in terms of our capital markets, in terms of equity, fundamentals, technical analysis, fundamentals, all of that will play a large role. Obviously, you can't go purely based on that. So that is where the fund manager's decision comes into play. So what this fund would really work is, this fund really operates in terms of the universe of stocks. So you've got your overall universe, all the CSE listed stocks, and then the list of companies that we select. So of the 250 plus companies in the CSE, the only ones we will focus on in terms of what we are going to look at investing will be based on a series of variables. So we've picked 5 overarching pillars in terms of technical analysis. And what we're going to look at is, of those, we've come down to 10 technical ratios, as it were. So what we would do is, we're going to look at these ratios, and only companies that hit a specific score. So I think that will be taken into a little bit more detail a little further down. But very simply, all the companies that fall within that score, those are the only companies that we are going to look at. Now, whether we invest in those companies or not is a different matter. So that's the most important thing that we need to point out. It's not that even if the company X gets a score and falls within what we say, okay, this is a technically or a fundamentally strong company in terms of these 10 variables, that doesn't mean we're going to invest in that company. All it means is this company is going to fall within our universe of potentials. The companies we actually choose to invest after we select that universe of counters would come into the fund manager's decision. So which is why this fund is not purely technical in the sense that, okay, the ratios say this is a good company, we're going to buy this company. That would be a recipe for disaster. Basically, what this very simply says is, the ratios say this is a good company. Right, now that the ratios say it's a good company, okay, that's tick, that's done. Now we speak to market, we speak to the markets, we look at the markets, we do our own internal research, all of that, and then we decide, okay, it's a good company, it also looks like it's got good potential, okay, we're going to invest. So that is essentially what this fund is. So this fund in that way is one of the first of its kind, in the sense that this is what a lot of us would do as fund managers. But here what happens is that first step, which is done ad hoc, here is done automatically. So we have our own inbuilt system, our own inbuilt database. We're using an online platform as well to make sure that there's no human error. So all the data is sourced from only one place. All the formulas, all of that is automatically generated. And what we do is, from that initial list of shares or equities or counters that we generate, then the fund management team will decide, okay, which do we want to go in, when do we want to buy, when do we want to sell, and you've got your standard fund management process. If we could go to the next slide, Bimasha. So yeah, so that is essentially what I just covered, just discussed right now. So this is what, this would just give you a very, very quick summary of what I said. So it's data driven, very growth focused. So we're looking at fundamental companies with long-term capital appreciation, high quality equities. And we are prioritizing one of our core ratios that we're going to be looking at is actually return on equity, because we believe that is something that should be strong across any company. We're also going to be looking at companies. And the other thing with this fund is that it's not limited to a specific company, it's not limited to a specific sector, it's not limited to a specific anything really. This is basically whatever sector, whatever company, if they're fundamentally strong, so which means technically they're doing well, or they're doing something right in terms of their business operations, that's what we're going to look at when we go into our next step. Bimasha, if we could go on to the next slide. So very quickly, before we go into the details of the fund, I'll just give a very quick summary, because I know several people have already asked us this. So a unit trust IPO is very different to an equity IPO. So here, the main difference obviously is you don't have any limitation. So there is no limit to the number of units that you can apply to. Whatever amount you want to get, you will get. Whatever amount you apply for, you will get that amount. NAV, very similar to a share price. You can think of it as in a very similar context. Okay, this is the net asset value per share of the unit trust, so to speak. So that's what the unit trust is. But there is no oversubscription, none of those things. There's no such thing. You basically apply, and whatever you apply for, you get. And there is no worry in terms of when you apply. You don't need to apply up until the final date. You need to apply, because the difference is from day one, obviously, this fund would start, the price would obviously start, or the unit price would start changing. Just to add, this fund doesn't have any front-end fees, no entry fees, no exit fees, nothing like that. So, there are no barriers to entry or exit. Bimasha, if we could go to the next slide. So this is basically a very, very quick summary of the fund. So the IPO is basically opening. It's just open now, so people can start investing now in terms of applying now. However, the thing with this fund is you can start applying now, but you don't really need to transfer the money until you get a little closer to the date, obviously, because otherwise, until the fund launches, you're not, the funds will just be lying there and not gaining an income. However, what I do is anyone who is interested to do the documentation now. So we have an online platform which makes the whole process easy. Everything can be done online. There's absolutely no need for any kind of, there is absolutely no requirement for any kind of documentation of any kind. So the fund will the IPO will close on the 24th, but from the 25th onwards, the units will go live. Our trustee for this is Hatton National Bank. So Hatton National Bank basically will oversee everything that we do. As I mentioned, the minimum investment here is only 1,000 rupees. So what that means is essentially 100 units. 100 units is the minimum amount, and that, but you can invest anything in multiples of 10 or above. The thing with the unit is there is no fixed amount. You can apply for 1,923 rupees and you will get 1,923 rupees worth of units. The other fees, these are the fees that the fund charges. So you've got a management fee of 1%, trustee fee of 0.2%, and there's a flat custodian fee of 20%, 20,000 a month. The thing about unit trust fees is all of these are factored into the fund. They're not charged directly from anybody. I just want to add at this point, obviously, I assume everyone on this call has a fair idea and understanding of unit trusts. But again, if you want to know a little bit more in terms of unit trust, in terms of what unit trusts are, the difference between funds, not specific to this specific fund, but unit trusts in general, you're more than welcome to give us a call. You're more than welcome to drop an email. You can email me directly. I'll be happy to reply to your emails. You can drop into our office, which is at Thumulla. It's at the Thumulla roundabout, right opposite the Dutch Burger Union, beside the laundromat. Anytime you're like, you are more than welcome to come have a chat with. If I'm here, you're more than welcome to chat with me. If I'm free, not a problem at all. You can speak to any of our fund managers or analysts, get an idea on unit trusts, what unit trusts are. You want to know, or you already know what unit trusts are, you want to get a little bit more info in terms of this fund, more than welcome to drop in as well. We are happy to help in terms of growing and helping people understand. So Bimasha, if we could go into the next slide, I believe from the next slide onwards, it will be the more technical side and what the fund does. So I think you'll be taking everybody through that section before we open for questions.
Yeah, yes, Jeevan. But before that, I have a few questions for you on behalf of everyone who has joined today. So let me start with the first one. What was the thinking behind introducing a factor-based, technically driven fund like the Senfin Select Factor Fund?
So I think, like I mentioned a couple of slides back, basically what we looked at is equity is positive. The markets are generally positive on equity. We're looking at a positive that markets have reached a point where technically sound fundamental companies should ideally do well. We're already seeing that already. Results, a lot of companies who've returned results have shown strong results, not on non-recurring income or one-off things, but on proper operational. So you're actually seeing you're actually seeing proper operational related growth. So that is one of the main things that we've decided on. So we're really focusing on the underlying instrument is positive. We're looking at a fundamentally, technically strong argument for equity as an asset class and for companies that operate in or listed companies. So that our argument is basically that is what should ideally move down into a technically based fund, because what we are saying is, okay, the fund looks at companies that are fundamentally and technically sound. So if they're fundamentally and technically sound, ideally, and at the same time, if it's the fundamentally and technically sound companies are the ones that are going to do well, hopefully excluding any one-off events, then ideally the companies that we are looking at through our fund will be positive. I saw a question pop up regarding what a custodian fee is, so I'll very quickly take you through that. So the custodian fee, basically HSBC is our trustee and custodian. So what that simply means is that is just another fee that HNB would basically charge. So custodian fee, what it very simply means is, with a unit trust, what happens is the funds are not with us as the asset management company. The funds, all the assets, they're all held through the trustee. So for example, what that means is Senfin Asset Management does not hold any of that money. We invest basically the money through the trustee. So the reason this is done is for security. So basically HNB is the custodian. They are in custody of the assets of the fund. So this is a flat fee that is paid. It generally doesn't increase. So it's a flat fee that is paid to them just for them to do what they do. On the other side, what we look at is we look at the trustee fee. Any other questions?
Yes, Jeevan. So the majority of unit trust funds at Senfin Asset Management are equity focused. So what is the reason behind this strategic focus?
Again, well, even before markets moved up in terms of equity, we've always been weighted more towards equity. So in addition to what I mentioned earlier regarding equity being the positive, all the reasons in one of the earlier slides why equity. So Bimasha, if you could just go back to that why equity slide.
Yes.
So the reason we are looking at that is what we focus on is we're looking at equity, that equity is going to move forward. We're going to have to assume that the government is going to focus on keeping interest rates low to stimulate growth, to stimulate economic growth, to control inflation, all of those things. So if this is the way it's going to be, and people are going to look at alternative sources, I mean, other than say gold or real estate in general, you would look at equity. And when you're talking about capital markets, it's really going to be these two, the fixed income side or equity. So our focus has always been equity, and that's what we're really going to be looking at. So that is why we've gone a little bit more into equity. The other reason is, in terms of fixed income, as it is, this market is very large unit trust. So there are a lot of fixed income unit trusts. There are a lot of much larger fixed income unit trusts out there. So what we are looking at is we're looking, okay, I think the fixed income market in terms of unit trusts is pretty well covered. There are quite a large number of them out there. So let's focus more in terms of equity, because we believe that going forward, equity is going to grow. So, yeah, that would be why.
Yeah, thanks, Jeevan. And also just one last question. What are the potential benefits and risks of the Senfin Select Factor Fund, and how does it fit into today's market environment?
So very simply, in terms of equity, the same risks that generally would apply to equity would apply to an equity unit trust. I'll skip over the part for now where it is technical fund specifically, but any equity-based unit trust ideally should have the same kind of risks that are there for the underlying instrument. But the difference is a unit trust is professionally managed. Our fund managers, what they do is they manage the fund, so they know what they're doing. On top of that, there are a lot of other advantages in terms of you got your diversification. You can diversify the funds. You're not constrained. So for example, say you have only 100,000 rupees to invest in equities. If you want to make a meaningful return, you can't put that into many shares. You can only put that into a few shares. But 100,000 in an equity fund, basically that 100,000 gets split amongst all the shares the fund has invested in. So you actually get exposure to different sectors, different investors, a lot of different things, which you would not get if you were to go direct. In addition, as I told you, the point of a fund is to outperform the market. So the whole purpose of an equity fund is the fund manager should be able to outperform the underlying instrument, which in this case, again, is the Colombo Stock Exchange or the ASPI, the benchmark. So essentially, the main advantage there is you get all of those additional things coming in through a unit trust opposed to going directly. The risks, again, as I said, in terms of risk, again, I don't see any major difference in terms of risks, in terms of what you get from a growth fund equity that you would have in a growth fund. However, to some degree, that risk is mitigated due to the factors I've mentioned before, diversification, fund managers, all of that. In addition to that, to come back to what I mentioned, I said I'm skipping earlier about the technical fund. So what you have to assume is, unlike a normal company, a fund that you are saying is positive in terms of it's fundamentally sound, or it's technically sound based on key underlying hard variables. If you say that this fund is positive, or these stocks are based on strong fundamental variables, there may be times where you have trading stocks that do better. But in the long run, assuming the country gets its act together, we get our macro act together, things are generally okay, these are the companies that are going to do well. So when things go well in terms of the markets in general, these companies will do well. The flip side to that is when there are sudden shocks. Again, companies that are fundamentally sound will be able to weather those storms better than companies that are not. So that is the second factor which we look at in terms of this fund that strengthens the argument. Bimasha, there was a question I only saw the first two lines of it. To do with performance.
So that is, yeah, would you like me to read that out?
Just read it out, yeah.
Yeah, so based on your research or past performance of similar funds, what is the estimated annual return, profit percentage we can expect from the select factor fund?
Right. So one of the main things about unit trusts is we're specifically told we can't guarantee a return. So one of our SEC mandated things is past performance is not indicative of future returns. So, but what we are basically looking at is we're seeing very strong market growth. We're seeing very strong equity growth. Last year was a fundamentally good year where we saw almost a 30% plus growth in equity markets. This year has continued. It's doing quite well this year as well. So what we are expecting is, if things keep going this way, markets should do as well as they did last year. It's very hard to forecast equity, so we can't give an exact a rate for equity. Not that you're not supposed to, you actually can't. So we can't give like a 1 year forward and say, okay, if you invest today, you're going to get 30% within 1 year or something like that. But if equity markets are expected to continue growing at this rate, so we've seen them grow, from 16,000 to 17,100 in February, from, it was 10,500 in September. ASPI moved up to 17,100. It dropped to about 15,000. Now, again, it's gone up. So what we are expecting is, strong return, might even outperform last year. A very good chance of it outperforming last year's return. There's no exact fund exactly like that, so I'm speaking based on our own funds. We have a financial services fund, which actually returned 62% for the full year last year. So our growth fund, which is, if you would look at the other end of the spectrum, our growth fund was 31%, which is basically that invests in any company. There is no specific factor. And then we have our financial services fund, which is specifically into financial NBFIs and banks. So that fund gave about 62%. This fund gave about 31%. So what you're looking at is what our growth fund gave, what our sector-specific fund gave. This fund would fall somewhere in between that, but based on how things are this year. Bimasha, there was another question.
Yeah, there's another question, Shivan. So is a monthly custodian fee fixed irrespective of the invested amount?
Yes. So the only fee that really changes would be the management fee. So you're looking at 1.2% is the management fee. That also is flat in the sense that those fees don't change. So we've never increased our fees. We've only brought down our fees. So our money market fund, for example, is 0.15%. So we've been continuously bringing our fees down. Our money market fund has one of the lowest fees in the industry. Our equity fund fees are also one of the lowest. So 1.2% is a flat fee that gets charged as a percentage of the net asset value. There are no other fees other than that, and the custodian fee. Custodian fee as well doesn't increase. Normally, the custodian, the custodian fee is a flat fee. If at all, they only increase the trustee fee, if at all. But again, in recent times, they haven't increased the trustee fee. The reason being is the amount they get goes up monthly if the net asset value of the fund goes up. So this, very simply put, you that 1 and 1.2 will not change, neither will the 20,000.
So I think that's about it. The questions that we
And
have in
we'll
the
open
chat
the
box.
floor again, I think, at the end, once,
Yes, at the end.
once you do the next, for
Yes.
even more questions. So everyone, if you all have questions, please ask as many as you want. You can send them as a message as well. But I think I'll hand it over to Bimasha to take you all through the more technical side of it before we open for further questions.
Yeah, thanks, Stephen. So moving on to the fund criteria and process, so just like mentioned before, the investment objective of this fund is to provide long-term capital appreciation by investing in fundamentally sound equities listed on the CSE, so that are selected based on an internally developed mechanism. So this fund follows a disciplined, data-driven investment strategy focused on identifying companies with financial strength, sustainable performance, and future growth potential. So as you can see on the screen, we evaluate companies for selection into the investment universe using these 5 key pillars. So which are profitability, we have debt servicing, cash generation, market performance, and dividend history. So each of these pillars are then assessed through 10 key financial ratios. So these are our KPIs, which include first the return on equity. So this is our primary indicator for the fund. This measures how efficiently a company uses shareholders' equity to generate profit. And next we have net profit margin. This shows the percentage of revenue that remains as profit after all the expenses have been deducted. And then we have the debt to equity ratio. This indicates the proportion of debt financing compared to shareholders' equity. And next we have the cash ratio. This measures the ability to pay short-term liabilities using cash and cash equivalents. And then we have the price to earnings ratio, which compares a company's share price to its earnings per share. Then dividend yield, which shows the dividend income as a percentage of the stock price. And also we have the dividend cover. This indicates how many times earnings can cover dividend payments, showing dividend sustainability. And also we have EV to EBITDA, so that is enterprise value to earnings before interest, tax, depreciation, and amortization. And once again, this is a valuation metric comparing the enterprise value to operating earnings, indicating the company's value relative to cash flow. And we also have free cash flow to earnings. So this measures how well earnings are converted into actual cash flow. Then cash and cash equivalent to total debt. This shows how much cash and equivalents a company has relative to its total debt. So this is a rough idea about what the ratios do mean. So each of these, each company listed on the CSE is then evaluated based on 10 financial ratios with set specific benchmarks where a company will earn 1 point for each criteria it meets. So if I'm going to, if I'm to take you through the benchmarks, so first of all, ROE must be above the market average so that we ensure that we only select the companies generating strong returns from shareholder capital. Then net profit margin should be above the sector average, indicating operational efficiency and strong profitability. And then debt to equity ratio must be below 50%, highlighting the companies with lower financial risk. And then the cash ratio should be greater than 0.5 times, showing the company that has enough liquid assets to meet short-term liabilities. And then we have price to earnings ratio. So this must be below the sector average, helping us to identify the attractively valued stocks. And then the dividend yield should be higher than the market average, ensuring better income potential for investors. And then the dividend cover must be above 2 times. And this reflects the company's ability to sustain and grow its dividend payouts. Then EV to EBITDA should be under 10 times, indicating reasonable valuation relative to cash flows. And then free cash flow to earnings needs to be greater than 1 time, demonstrating that the company converts its profits into cash effectively, into real cash effectively. And cash and cash equivalent to debt must be above 0.5 times, ensuring strong liquidity and debt coverage. So once we have calculated how many benchmarks a company passes, we then apply a selection decision tree to decide whether to include a stock in the investment universe or not. So first we check if whether the ROE is greater than the market average. So if yes, and also if the company meets at least 6 out of the total benchmarks, then that stock is accepted into the investment universe. So if the total benchmark score is below 6, then we reject it. And also, there is another exception to the benchmark criteria, to the initial benchmark criteria. So here, if the ROE is below the market average, we still do consider companies that are very strong on other fundamentals. So in this case, if a company meets at least 8 benchmarks and its ROE is still above at least 75% of the market average, then we do accept them as well. If not, anyways, we reject it. So the companies that achieve a total score of 8 or higher, but do not meet the exception to the benchmark criteria, that is the second filter. So where the ROE must remain above 75% of the market ROE, then they will be placed on the watch list for further evaluation. So this scoring system ensures that we select companies that demonstrate strong and consistent performance across multiple sectors and not just one. So finally, we rebalance the portfolio every 6 months to adjust for changes in fundamentals, and we remove underperformers and also to include new high potential entries. So that brings us to the end of the fund overview for the Senfin Select Factor Fund. And yeah, so for more information about this fund and all the other funds managed by Senfin Asset Management, you could always visit our website at www.senfinassetmanagement.com. And you'll also find detailed information on each fund on our website. You can download soft copies of the application forms and other relevant documents directly from the site. And also, if you need any assistance, you can call us on our hotline listed below. Or you could even visit our head office, where our team will be happy to help you with the application forms or any queries regarding the unit trust investments. So yeah. So I think this is about today's presentation, and now we would like to open the floor for any questions that you may have. And please feel free to unmute yourself and ask your question, or if you prefer, you can even type your questions into the chat box and we'll be happy to address them.
Yeah, so Bhimash, I think there was one question that had already come in the chat box while you were speaking in
Yes.
terms of the liquidity level of this fund, which is a good question. So basically, this fund is an equity fund. So while you don't look at having the kind of liquidity that you have in a money market fund, in general, we in all our equity funds, we focus on being able to give our funds within the day. So basically what you have is you've got very strong liquidity. That is something that is an internal policy. So normally what we look at is if it is maybe more than 3 to 4% of the size of the fund itself, we would ask for about a day or so's notice. But anything smaller than that, we are generally able to repay within the day. So our cutoff for redemptions is 3 p.m. But if it is over 5 million, which is the RTGS limit, we kindly ask investors to let us know prior to about 10 a.m. in the morning. But anything other than that, anything under 5 million, if you let us know by 3 p.m. of the day, you'll get your funds within the day. Anything larger than that, we obviously ask, maybe a day's notice to also. Again, that is linked more to the size of the fund. So if the fund is very large, even a 10 to 15 to 20 million investment would not be an issue. We'd be able to pay it within a day. But very simply, that's what we look at. So we generally focus on having very high liquidity. Anyway, the fund needs to ensure that the fund is liquid anyway. So we normally look at focusing on keeping at least 3% of the total value of the fund liquid for any point of time. So what that means is if your fund is whatever size of the fund, at least 3% of that fund needs to be on an almost overnight basis. But we generally maintain about 10%. So what that means is if the fund size is only 100 million, 10 million, still 10 million up to 10 million would be redeemable almost on an overnight basis. Again, this is for an equity fund. So normally for equity funds, you look at a slightly longer holding period, but we focus on liquidity. So liquidity generally is not an issue for us. So you won't have any issues there.
We have one more question. So, can investors switch between different unit trusts managed by Senfin? And if so, how does that process work? So, yeah, you can switch between unit trust funds. So basically, you can send us a request via email, or you could even get a switch form, or even you can do it on our online portal. So yeah, that's possible.
Yeah.
And
Sure.
yes,
So basically, how that works is, Bimasha, yes, we can switch between any fund. So our online portal, it has the option to, you can switch any day between, at any point of time, you can switch between funds. So the whole process is online. So if you have money in funds in our money market fund, you can switch it to the next fund. So there's not an issue. There's no issue whatsoever in terms of switching. You can switch back and forth. Obviously, if there are any funds that you're switching to or switching from that have front end or exit fees, those fees would apply. But just to mention, this fund has no entry or exit fee, neither does our money market fund. So what a lot of our clients that we currently have do is, they have funds in their money market fund account, which currently I think our current yield is about 8.1 to 8.2%. And then when they feel like it's time to, they want to switch into equity, they will do a transfer from the money market fund to the equity fund. So if you have a fully online our online portal fully active, you don't need to call us, you don't need to email us, you don't need to do anything. The entire process can be done online. There's one small thing that needs to be mentioned there in terms of how redemptions and creations work. So for an equity fund, what happens is, for example, if you were to put your redemption, you were to request a redemption today, you would get the funds tomorrow. So the reason for that is nothing to do with us or in terms of liquidity, but it's to do with the pricing methodology of the fund. Basically, what that means is, otherwise it's to prevent people taking advantage. So basically what happens is, if the market, if you have, say you have an investment and the market, you don't have any money in the fund and the market jumps up today, if you were to invest today, you would get after that increase, but not on the day itself. So the opposite is also true for redemptions. This is a normal process for equity funds. It's nothing special that we do. It's to do with the valuation methodology of a fund or the pricing methodology. So if that's, we are happy to explain these things also in detail, because these are specific to the product. And by product, I mean the unit trust. I don't mean our fund, but unit trusts in general. So these are things that we can do. I mean, if people are interested, we're happy to do another session on unit trusts in general, the different types of funds and how it works as well. So we can look at doing something like that as well. Do we have?
Yeah, we have another question, Jeevan. So what are the new initiatives in your pipeline other than this?
You mean in terms of funds or in general? Well, if you, I'll do it in terms of funds first.
Yeah.
So in terms of funds, we've got another 1 or 2 funds. Again, innovative funds like this. As I told you, we're not looking too much into fixed income. We're focusing a lot on equity funds. Basically, what we're looking at is, we are looking at having a fairly large group of different fund types. So what that means is, when you transfer your money to us, you will get exposure to whatever different sector you want. So we have a dividend fund, we have a fixed income types, of short-term money market fund, long-term income fund. We have 2 Sharia compliant funds. We have a growth fund, we have a consumer sector fund, we have a financial services fund, you have an insurance sector fund, we have this fund that's coming up, plus another 2. So basically what that means is, as opposed to just going into a standard growth fund, which is just a fund, you get to diversify within fund types. So for example, our dividend fund, which is one of the better performing funds in general, is a fund that invests exclusively in companies that pay dividends or have a history of paying dividends. So the advantage with that is, you're investing in a fund that sees both a regular capital return as well as a dividend return, and that fund will in turn pay dividends out of that fund as well, only for that fund. So that fund is, so similar to that kind of fund, that's the kind of thing that we're looking at. So we're looking at really innovating in terms of the types of funds. We're not looking at having 1 or 2 extremely large funds. We're looking at having several smaller funds that really give clients that option. And the other thing that really, the thing that we're looking at is in terms of our online platform. So one initiative is in terms of the fund. Another thing is the online platform. So we have a fully fledged online portal. Basically, anything you can do with the bank portal, you can do with us, except for direct transfers through an account, like say what you would do through Lanka Pay. So that is something that we're looking at going, but obviously because there's a security element to that, we want to get that right. Our app will be launched very soon. We're partnering with 𝐶𝐞𝐧𝐼𝐻 Finance for a lot of things moving forward. So we're going to really look at working very strongly with our parent company as well, across the country as well, and combine both their product offering and our product offering up and down as well. So yeah, that's basically what we would be looking at.
Yeah, so I think we have another question as well. So is there a lock-in period for this fund, or can investors redeem their units at any time?
No lock-in period. So again, as I said, no entry fee, no exit fee, no lock-in period, no minimum 1 year, minimum 2 year. You can put and take money anytime you want to, subject to the minimum investment size for creations of 1,000. Redemptions, of course, literally any amount you want to take, you can take. There is no up to the value of the unit. So as if the unit is, say, 15 rupees, up to a minimum of 15 rupees, you can redeem if you want to. So there's absolutely no lock-in period on this fund. Obviously, it comes down to your return and your where you stand. So that's where we look at in terms of the online platform. So once you log into the online platform, you'll actually be having all the information at your fingertips. So you can very clearly see how the fund is doing, what your returns are. And if you feel, you've invested at the IPO, you invested at 10 rupees, it's gone to 15 now, you're happy with that, you can redeem the full amount, you can redeem the profit, and even that you don't need to take it to your savings account. You can just instantly just do a switch straight to the money market fund. So instead of that money being redeemed, going into your savings account and getting peanuts in terms of your interest rate, it will at least get a better return, maybe 8 to 8.1% on our money market fund, until you decide what you want to do with that next. So that is something that we're really looking at, that flexibility for investors to put and take money. Just to mention, the only funds of ours that have any kind of entry or exit fees are basically the growth fund has an entry fee. It's a front-end fee. And it also has our income fund has a exit fee. So that exit fee is only if you take the funds out under a year. If you have your investment for more than 1 year, there's no fee there. The growth fund just has a fee on investment only. And our Sharia balance fund as well, which is a Sharia compliant equity fund, that also has a front-end fee. Other than those funds, none of our other funds have any kind of entry or exit fee. So the money market fund, the dividend fund, the consumer fund, the financials fund, the insurance sector fund, the new Senfin Select fund, no entry or exit fees whatsoever.
There's one more question, Jeevan. Would you like to take that too?
Yeah.
Yeah. So similar to a company IPO, can a unit trust fund IPO be oversubscribed, or how does the process differ?
No, so I think I mentioned this at the start. There's no such thing as oversubscription or anything like that. Whatever amount you want to invest in the fund, you will get that amount. So there is no maximum quantity that we are offering. There's nothing like that. So basically, the size of the fund will be determined, or the opening size of the fund will essentially be determined by the amount of funds we've collected as at the launch date. So the fund can, and that's the difference. So you can keep investing in the fund at any point going forward.
All right, so I think that's about it with the questions. So with that, we come to the end of today's webinar. And also, I just want to remind, please stay tuned for our upcoming Sinhala webinar happening on the 17th of June at 4 p.m. So where we'll be diving into the same content in Sinhala for a wider audience, and also keep an eye out for more updates and informative posts about the fund on official channels. So yeah, until then, take care, and thank you once again, everyone, for joining us.
Thank you. Thanks, everybody.